with a little bit of a hotter non-farm jobs number and a little bit of a hotter average hourly earnings number, does that put a dent in anybody's rate cut plans? We knew just to bring on about that. What a great segue. I'm getting a little bit better at this job, Mr. Bolanos. We've got Craig Bolanos
You're
coming.
Like full-on professional, Scott.
And I'm embarrassed. I embarrass myself daily. I'm here to make other people look good, but I wanted to make sure that I got your new tag out there. Perfect. So you've got a new name for your firm, and you're the founder and wealth advisor at VestGen Wealth Partners. VestGen Wealth Partners in Chicago. He's the founder, and I think I got that right. I mean, I'm reading it word for word as you said it to me, so hopefully you got it right too. Does this put a dent in our rate cut plans?
No, it doesn't. With 200 print of 227,000 jobs versus 214, that's kind of right where I'm okay seeing it. The month-over-month increase in wages of 0.4%, that's 2 back-to-back months now. That's a little hot. A headline unemployment of 4.2%, not surprising, as Milton is off the books, the Boeing strike, and people came back into the workforce. But the year-over-year wages now, year-over-year wages at 4%, it's great for workers. But remember, the more money we put in the hands of workers, the easier it is to do discretionary spending, the easier it is for inflation to spark a bit higher. I think that means we still get our rate cut in December, but then the Federal Reserve goes on pause, making every single mortgage broker disappointed for Q1 and Q2 of 2025.
Well, the 30-year has been coming down, so 6.69 I think I read yesterday. I don't know what it's doing now, but and to me that's really low. But I mean, everybody that's got a 2.75 thinks that's really high, but they're not as old as I am when you had a 10.75 or an 11.75 back in the day. But I would say they're going to cut. I think you're right. They're still cut. I don't think they should, though. I'm going to go on the record. I think going into this new administration, there's so many things still out there with these kind of hot-ish numbers. Why take one of the tools out of your kit if it does get a little bit too hot too quick? I mean, too hot too quick. I mean, you might be going the other way real fast.
No, it's interesting, Scott. I mean, it goes all the way back a couple of years now. You were very critical that the Fed was far too slow to react. Now you're worried that they're pumping antibiotics when the patient doesn't actually need any. Are you going to be right on both sides of the coin? Gosh, I kind of hope not, because it's been nice what's occurring. I mean, they've been threading a needle that's incredibly difficult to thread, which is engineering this soft landing. Now trying to engineer a soft landing that turns into a no landing. And remember, never say never. I think the rate cut in December is good because I think the market wants it. I think the Fed wants the market to be happy. I think the Fed wants to protect the wealth effect. I think the Fed has clearly told the incoming administration, especially our newly appointed to-be Treasury Secretary, that they got to pay attention to deficit spending. They can't do too much stimulus. And if cool heads prevail, yes, I put on the table for 2025, we could have a no landing scenario, the likes of which we haven't seen in a long time. And then I'll wait for Alan Greenspan to come out of retirement and call me and remind me of irrational exuberance.
Yeah. Well, I mean, look, I got to get on board. I've been, it's my job as a broker to keep my customers out of trouble, right? And so that's when if you had a great aunt that died and gave you $5 million right now, can you plow it into the S&P up 27% year over, on the year?
No, of course you can't.
That's okay.
Because the S&P 500 has too much asymmetrical risk with
right.
capitalization that's concentrated.
Right.
But you can do what everyone does, which is get a Warren Buffett book for December, get one for the holidays, and I'm pretty sure the trend is your friend. Mm-hmm. New highs make new highs, and the only free lunch for investors is diversification. Right. And I just don't think the S&P 500 is sufficiently diversified anymore.
Right. Very good. Great point. So, when in doubt, I take comfort in the numbers because they never lie. And since going back to 1928, that the Santa Claus rally they talk about really is talking about the 5 days in between Christmas and New Year's. Maybe some people will lump in the first couple of days of the new year in there. All right. So that's the Santa Claus rally time period. And going back to 1928, 75% of the time, you'll see a 1.65% increase in the equity indices during that time. So there's 25% chance it doesn't. But if you throw in a new administration, that moves it up to 1.85%. The return is 75 to 80% chance of a 1.85% return in that time period. So the numbers are in your favor to hold, is what I'm trying to say. So you'll probably be right.
The numbers are in everyone's favor to stay net long, but the numbers require everybody to go through a rebalancing exercise into the end of the year.
Look at you.
think that's what's key. People need to rebalance with discipline and purpose because we can't allow recency bias injure our portfolios and put us into the penalty box.
Look at you showing off like that and all smart and stuff. All right. Great stuff as usual. I love having you on a Friday morning, non-farm Friday morning. Thank you very much. Craig Bolanos. I already shut my machine off, so it's wealth advisor and founder of the VestGen, right? Is that right? Did I get that right? And say it.
Founder and wealth advisor at VestGen
Yes.
Wealth Partners.
Give me 6 months, all right? That's all I'm asking. All right. Thanks.